Hey everyone, I am Paul Moore with Bigger Pockets and Wellings Capital, and it is Saturday on Memorial Day weekend. Wait, is it Labor or Memorial Day? I get them mixed up. Yes, Memorial Day. And I am so glad to be with you. Today, we're going to be talking about, it's going to be Crisis Investing 101 again, and we're going to talk about top ways to minimize your risk in any market or any real estate market. But before we start, tell me your name, tell me where you're from, what you're up to these days. And if you get a chance, share this so Bigger Pockets doesn't fire me. And so Facebook and YouTube and the rest of the internet will know that this is valuable content. Hey, Jamal, good to see you again. Thanks for joining us. All right. Before we get started with top ways to minimize your risk in any real estate market, I'm going to tell you 10 reasons not to invest in real estate. Okay, so I know it's a real estate show, but we're going to talk about 10 reasons not to invest in real estate. Number one, you really love your savings account. Paying good interest, isn't it? Number two, you really love paying taxes. Number three, you'd rather own paper than a physical building. Number four, your mattress would not be as comfy without all that cash stuffed underneath it. Number five, you're wary of the term mailbox money. Number six, you want to make sure stockbrokers get their fees. After all, they don't make very much money, right? Number seven, you prefer buying CDs, either the banking kind or the music variety. We won't judge you. Number eight, you'd rather work for your money than receive passive income for doing nothing. Number nine reason not to invest in real estate. You want to teach your kids good old-fashioned values, including putting every penny into a savings account. And number 10 reason not to invest in real estate. You don't mind losing money to inflation. Life's more fun when you know the money you've saved is worth less today than it was yesterday. Hey, again, I'm Paul Moore from Bigger Pockets and Wellings Capital. And today we're going to, after that fun time, hopefully that was fun for you, we're going to be talking about all the ways to minimize your risk in any real estate market. So let's get started on that. Hey, Brian Spring from Kirkland, Washington, closing on your first fourplex out of state. I don't blame you for being out of state, my friend. Joshua Rayleigh. Hey, Joshua from Mountain Home, Arkansas. Roblex and more. Hey, got on here live. Thanks for going live. Hey, Jordan Williamson from Fort Myers. Hey, Jordan, if you want to talk later about getting some deals, if there's a huge economic downturn, Fort Myers is my number 2 city in America that I want to try to find deals in. So feel free to reach out to me. I'm not ready to do it yet, but give it about 18 months. Okay, so Crisis Investing 101, top ways to minimize risk in any real estate market. This is partially based on a wonderful article by Palak Shah, and that's in Bigger Pockets. It's trending right now. Hey, Palak. Sorry, I mispronounced your name. I'm sure I did. Okay, so let's go over some ways to minimize risk in this market or any market. Number one, maintain healthy reserves. Have some cash available. One way to do that is by having a line of credit available or home equity line of credit. If you haven't applied for that yet, I highly recommend that you get a home equity line of credit. Now, why? Well, you'll have access to the cash. We call it lazy equity. You don't want lazy equity because equity in your homes is generally not making you a lot of money, if any, probably no money. If you have it available, you might be able to take advantage of opportunities. So maintain healthy reserves. Number two, get a home equity line of credit or any type of line of credit. Now, some people think that it's best to actually get a line of credit and get that cash out of it. In other words, liquidate the line of credit and put that cash in a different bank in case your bank calls or closes a line of credit. I can't guarantee that will work. That might work. It might not. They could still call the loan. But hey, if you have the cash there, it's okay. And if you don't know about the thing about calling the loan, trust me, banks can do that. I know at least 2 large developers, well, actually a local developer in Roanoke, Virginia, and then one in DC If you all know, if you're in DC and you're driving along 66, the NRA building on the side of the road there, actually that was foreclosed in the middle of construction for no reason at all in 2009 crisis other than the bank wanted it off their books. So speaking of stuff off bank books, here's another tip to be ready for the downturn that's coming. That is, get to know bankers. Get to know bankers and get to know how to find distressed debt and how to find distressed assets. Okay, so get to know bankers and get to know how to buy distressed debt and distressed assets. I've been on like 4 phone calls in the last week with people talking about learning to buy distressed debt and distressed assets. Get to know that now get to know the process and get to know the people now. Your best bet is to get assets that are not being competed for by large institutional investors, and that would typically be in the $500,000 to $5 million range. Once you get above 5 or 10 million, you're going to be competing with the big boys who have huge advantage because they can get their cost of capital is really low. Bill Coppage, hey, Bill says get a line of credit now before banks tighten underwriting further. Great point, Bill. Thank you very much. Okay, so the next thing is focus on lower debt levels. Now, these can be measured by loan to value ratio. People were getting 70, 80, 90% loan to value ratios. If someone's going to give you a 90% loan to value, by the way, in this market, you're going to have a super, super safe deal. And there are some things out there like triple net leases from credit tenants like Amazon, renting as storage. I mean, if you owned an Amazon warehouse, you could probably get a 90% loan on that. It might not be that dangerous, but there are other things that are much more risky. I would recommend lower loan to value ratios and higher DCRs or DSCRs. That's the debt service coverage ratio. Now, the debt service coverage ratio you want to have for a bank to be happy is at least 1.25, but we recommend a much higher one, 1.5, 1.75, even 2.0. Currently, my Wellings Income Fund 2 has a debt service coverage ratio of 2.3. So that's 130% margin of safety of the monthly net income compared to our payment to the bank. So we have 130% extra. In other words, the banks only require about 25% cushion, but I recommend higher. Stress test your debt levels by checking the debt service coverage ratio and the break-even occupancy. And what I mean by that is this. If you have a 10-unit apartment, check out what would happen to your ability to service your debt if your current occupancy of 9 drops to 8, and then 7, and then even 6. What would happen? And go back to my first point, have a lot of reserves available in case that does happen. So stress test your debt levels by checking the debt service coverage ratio and break-even occupancy. Next, and this is from Pollack's article, automate by using systems and processes. So you need to learn to automate everything you can. Everything you can do electronically, anything you can do with automation, you should try to do, and everything that you can avoid doing manually. This is a good time to streamline that process. I talked to a real estate broker last night who said she used to drive an hour to get signatures on contracts just because she didn't want to learn to use DocuSign. And when she learned to use DocuSign, she realized she could do it at home in her PJs in 5 minutes and saved her hours and hours of driving. So learn to run online and remotely in case of a repeat of this virus. We all know it's possible that this virus, this pandemic, could come back and bite us again. Well, this is a time to learn to automate. This is a time to learn to run everything you can online. Now, I'm going to have some more comments about the online and remote thing later, but that would be a great way to go. Okay. Number 7, don't pay retail. Okay. If possible, don't pay retail. I had a friend, and it's possible that I'm wrong. I admit this. Okay, Bill. I admit I could be wrong, but I had a friend call me the other day and said, great news. Great news. I bought my first house. I got it under contract right now. And I tried to be excited for him, but I said to my wife later, if he would have waited 6 or 8 months, maybe a year, and if he could have just rented another year, he's in his late 30s already. I said he might have been able to pick and choose from much, much better deals. And again, I don't know that. Little aside, I have a team of real estate brokers at Smith Mountain Lake. I feed leads to residential real estate leads. And it's been going crazy the last 10 days. We have one of our realtors has one house that has 3 offers on it. People are fighting over it. Another house had 7 showings in one day, a week ago today. So I think there's some pent up demand, and right now could be a really good time to sell. There's actually not that many buyers on the market. So about 2 months ago, I sat here and told you that I thought prices were going to start to go down soon, but I think it might be a while, but I do believe it's going to happen. So don't pay retail if possible for real estate. Next, buy from mom and pops or other distressed sellers. Now, mom and pops aren't always distressed, but I'm talking about if you're going to buy from somebody who has 100 rental houses, you're not going to get a great deal, at least not now. You may someday if they become a distressed seller. But right now, if you're going to buy, try to buy from somebody who has 1 rental house they're trying to get rid of, or maybe somebody who inherited a house. And if you can find a distressed seller, someone who's in trouble and they have to sell, you can actually help them. And I mean that sincerely. You can help them. You can help the bank by them not getting it back. You can help yourself and your investors. You can do a lot of good in a time when there's a lot of hardship coming our way. So next, control without owning. How do you control without owning, Paul? Well, I'm glad you asked. You can do that through lease option sandwiches, and you can do that through subject to mortgages. Okay. Now, what I mean by that is somebody on here last week said, I have $100,000. What could I do with it? Could I buy maybe 2 houses? And I said, you could probably control 10 or 20 houses if you use lease option sandwiches or subject to mortgages. I just finished reading a book. It's been a month ago now, called Real Estate on Your Terms. And that's by Chris Prefontaine. He is an author of Bigger Pockets. He does blogs on Bigger Pockets. Chris Prefontaine, you can go to his website. I actually don't know the name of his website because he sent me a book in the mail, but it's called Real Estate on Your Terms. It teaches you to do this. There's also one by Bigger Pockets, Joe McCall, and it's called Wholesaling Lease Options. You can also, wholesaling lease options is another way to control without owning. So my friend Bill Coppage has this next one. He said, partner in recession-resistant real estate classes with operators that did well before the last Great Recession. So the GFC in 2007 to 2010. Find an operator that was at their business, their current business before that, and invest with them in recession-resistant asset classes. So I guess the title on that would be Partner with Experienced Operators in Recession-Resistant Assets. If you're going to do that, there's a couple tips I want to give you. This is from my due diligence process that we use. And we have a 25-point due diligence process. Here's a couple things to look for quickly. What is their track record? Ask them about their worst performing deal. Meet the key people by video or hopefully in person at their office and on site. Get comfortable with them. Have a good gut feel. See how they treat their employees, their investors, the waiter or waitress or flight attendant. See how they talk about their wife. Look at the code of honor. we got a great new book out there. Nikki's going to tell us about it. It's Nikki's our producer here at Bigger Pockets. Thanks, Nikki. It's called The Hands-Off Investor. The Hands-Off Investor by Brian Burke. My friend Brian Burke wrote this book, and it will teach you to partner with great operators. Look for their moral compass. Brian says that's the number one thing to look for. Visit the properties in person. Look, it's worth the price of a ticket. If you're going to invest $50,000 or $100,000, it's worth jumping on a plane. Fully review the PPM, the operating agreement, etc. Check what kind of debt they're using and what the risks are with the debt. Ask them to stress test and show you what happens if the occupancy drops by 20% and if rents drop by 10%. Run Neighborhood Scout yourself. Do Google Earth and go see the property, online. There's all kinds of things you can do to be ready. Okay, so this next one and a couple more came from my friend and one of my heroes, Kevin Roop. He's a real estate investor up there in Northern Virginia. He says, act ahead of the herd. And that reminds me of Howard Marks. Howard Marks has a book called Mastering the Market Cycle, Getting the Odds in Your Favor. And I always recommend that book. And he says, act ahead of the herd. Now, you don't always have to act exactly opposite of the herd because that might not always work. But honestly, when people are fearful, you need to be greedy in the sense that you need to be buying when they're selling. And when people are greedy, that means when they're buying everything, it's probably time for you to sell. Ken McElroy, one of the greatest multifamily investors ever, just sold $200 million in assets last year because he had a sense something was going to go wrong this year. And as we can see, they really has. Act ahead of the herd. Remember this saying, it's been attributed to Buffett and others. What the wise do in the beginning, fools do in the end. Okay, that can apply to all kinds of different things, okay? So like the wise are storing up, they're storing up reserves in the beginning. Well, fools try to do it at the end. The wise are buying when the market is terrible. Fools buy in the end when the market's great. The wise are doing great things, raising their kids and connecting with their family on a Memorial Day weekend, while fools try to connect with their family after the kids grow up. Okay, that was a little side thing. But anyway, you get the idea. So, okay, be aware. Kevin Roop also says, be aware of current values. Now, in commercial real estate, the value is the net operating income divided by the cap rate or the rate of return. You should always have a handle on your current value of your assets. What's the cap rate running right now? What's the net operating income? Next, Kevin says, have certain assets that are quick cash converters, assets that can be converted to cash very quickly. So have certain assets identified as quick cash converters. Next, I already said this, get to know bankers and learn now how to buy distressed assets. So get to know bankers, learn how to buy distressed assets and distressed debt. And last, account for taxes in your calculations. Now, there's a lot of people who think if I just sold this asset right now, I would have this much in my pocket. But I talked to somebody the other day in Southern California who was telling me that they would actually, they realized after they accounted for taxes, they had a huge crunch on their take-home pocket money. And so I've been researching this for a while, and I've identified 6 different ways to avoid or to delay taxes. And so we can talk about that if you ever want to do that. But some of those ways include having an installment sale or a modified installment sale. You can also invest in a Delaware statutory trust. You can invest through a 1031 exchange. There's also other type of things like deferred sales trusts, things like that. It's possible to do lots of things to avoid taxes. So hopefully that will be of help to you. So Dude Real Estate is joining us this morning. That's Nate Shields. He's a writer with Bigger Pockets, and he is going to try to field some of the earlier questions that I didn't get to. So Nate, if you want to go up high in the question list there and try to answer some that we don't get to, that'd be great. This is the end of my presentation on how to minimize your risk and hopefully maximize your return in any real estate market. And so now I'm going to go to live Q&A. So Nikki, our most amazing, wonderful, incredible producer, is going to choose some questions, and I'm going to have at it. So Rob Lux and more says, I'm in that situation. I sold my house and decided to rent, but my lease is expiring and I got to leave this place. You're not in a bad situation. Trying to find a fixer-upper for cheap, but it's very hard. Yes. What fools did in the beginning, I'm not saying everybody's who bought recently is a fool. I'm not saying that. Maybe I need to reel that back in, Nikki. No, seriously. People buying for above top of the market, which people have been doing lately, some of them are going to lose those properties. And Roblox and more, if you can just hold on a little bit, if you can. I told my friend the other day, I said, look, Airbnbs right now, at least the last few months, have been sucking wind. You could probably go find an Airbnb at cheap and just offer them a month-to-month lease. And you could do that possibly, for a while until this market completely turns. Right now, it hasn't turned. And so anyway, so Charmaine Schmidt says, that was me. Hi, Paul. Hey, Charmaine. I'm not sure what was you, but good to see you again. I saw you last week. All right. So Bill Coppage says, get a line of credit now before banks tighten underwriting further. That's absolutely true. Bill's right. Bill's been in Wall Street and the banking world for how many years, Bill? Like probably longer than most people on here have been alive. And Bill knows what he's talking about. So thanks, Bill. That's absolutely true. Ale says, what's your opinion about Miami real estate market? Too inflated to buy or due to demographics? Would it be smart to buy even today? Thank you. Okay, so all this is my opinion. Of course, I'm guaranteed to be wrong with any forecast. Every forecast is wrong. The question is by how much and how much off on timing. So a recent survey by Attom Real Estate Solutions says that Broward County, just north of Miami-Dade County, is actually going to be hit worse than Miami. So if you can go one county north, like 8 miles north, that only takes like an hour, right, to drive those 8 miles. I'm being, silly, but I know the traffic there is really bad. I would say that Broward County would be better from what I've heard, and that is based on incomes, unemployment level, property prices compared to loan amounts, all kinds of things that are showing indicators that the Broward County, Fort Lauderdale area might be a little better. Oh, in answer to your question, I would not buy in Miami right now. I think it's got 12. I think in general, we've got 12 to 18 months until property values really, really drop significantly. Right now, there's a gap between what sellers think their property's worth and what buyers are willing to pay. And that gap is going to take some time to fill. I don't know if you've all heard about the 5 stages of grief. Go Google that. Those 5 stages of grief are the same thing real estate investors and owners who want to sell go through, and they're going to have to go through those stages. Right now, I'd say we're in stage number 2. Stage number 1 is denial. Stage number 2 is anger. So people deny that the COVID was going to be any big deal. And maybe people are still in that place in a lot of cases. And then phase 2 is anger, that they're angry that they might have missed the top of the market. And so you can look up the rest of those stages of grief. Hey, Todd Merritt, when do you think the market will drop from COVID? I've been watching it in my area, at least. Things are still selling for a 3 to 4% cap rate. Todd, if you look back at 2008. So the crisis in 2008 started in 2007. The worst part of the crisis was fall 2008 and winter going into 2009. The bottom didn't hit. Now, foreclosures maxed out in 2009 and in 2010, but prices didn't bottom out till first quarter of 2012. So real estate prices are completely different than the stock market. It bottomed out in 2000, I think it was February 2009. And but it took the real estate market 3 full years to hit bottom. That's one of the huge advantages you have as real estate investors. You've got time to react. You've got time to train yourself, get a team together, get a tribe of followers, and get ready. You've got time. And I think you've got maybe a year or two. Now, I don't know. So Ramsees says, can you repeat the part of accounting for taxes? Thanks for joining us, Ramsees. So yeah, I was just saying, make sure you count what could be your largest expense at in operating a property or in selling a property, and that is taxes. Now, there's ways to avoid taxes, and most real estate investors know that. I've written many articles in Bigger Pockets on avoiding taxes. You can look those up. And there's a couple books out there on avoiding taxes. Amanda Hahn, I think that's right, isn't it, Nikki? I think Amanda Hahn has a book about accounting for your real estate properties and avoiding taxes. So I'd highly recommend that you get a copy of that book. So yeah, Kubler stages of grief. Thanks. That brings a new perspective. So let's see if we can remember what the 5 stages of grief are. Number 1 is denial. Number 2 is anger. Number 3 is negotiation, where people, they start scrambling and negotiating. Hey, they'll call back and say, hey, I might take that offer that you made me last year. I'm willing to negotiate now, where they hung up on you a year ago. And that really happened to me once back in 2008, by the way. Let's see, negotiation. Number 4 is depression, like where they're so depressed. And number 5 is acceptance. And when you get to acceptance, that's when you're going to get the very best deals on real estate. And it's going to be all over the board, so I'm not really sure. Sam S. says, I want to invest in cash flowing multi-unit properties on the East Coast. Where or how do I suggest, where do you suggest I start my research, and what about waiting till prices drop? So Sam S., I personally believe that prices might, okay, so there's 14 New Jersey counties and 10 Florida counties where they believe prices will drop most. I already mentioned Broward County. Orlando looks like it's going to have a huge drop. I would look for the sand states. There's only one sand state on the East Coast, and obviously that's Florida. And then the sand states on the western part of the U.S. are Nevada, Arizona, and California. And I would consider, except for California's landlord laws are really difficult, but I would consider investing in those type of areas, and I would wait till the price drops. Learn now to buy distressed assets. Learn, go to the auction on the courthouse steps now, even if you're not ready to bid. Hey, you might get a great deal. I've done that. I went to the courthouse steps never expecting to buy anything, and I ended up buying because I saw a great deal. So, and get to know local or regional bankers and credit unions. Sam S. says, do real estate. Thank you. What about reading material or resources or websites that you recommend I start with? Sam, there is just no better place than where you already are. Bigger Pockets has the best resources, the best books, the best podcasts on real estate investing, especially our type of real estate investing, what we're talking about here today. And there's a library, a bookstore at Bigger Pockets. And Nikki's already showed Matt McFarland and Amanda Hahn's book, Brian Burke's book. I'm really excited to be writing a self-storage book that's coming out this summer, I think. Kevin Roop says, thanks, Paul, and thanks, Bigger Pockets. Essential thing you need to do now as a real estate investor is join Bigger Pockets. Yeah, right, Kevin. And also join our pro or premium services. It's one of the very best, if not the best, decision I've ever made in like 30 years in business is being part of Bigger Pockets. And I'm dead serious. I told everybody that. Stephen Holiday says, update, last week you gave me some tips. I'm going to be held accountable for something I said on converting a local Kmart into storage. Yesterday I drove by and they were renovating the property after nearly a year vacant. I asked one of the guys having his lunch, it's going to be a what? A probation office. Well, the government's got a lot of money to buy. That's a big box for them. I guess one landlord is glad the governor released all those convicts. Stephen, I'm truly sorry. I went by Kmart in Roanoke, Virginia after I had this idea too, and they were renovating it into a self-storage. The Sam's Club out on, what's that called? Hilton Head Island. It's being renovated into a beautiful self-storage. The Super Kmart in Reno has already been renovated into a self-storage by our friend and Bigger Pockets podcast guest, July 4th, 2018. Easy day to remember. AJ Osborne. So yeah, there's a lot of places to do that. What's your opinion on the future outlook of single-family homes, says JC. Has social distancing influenced families to rent homes versus apartments? Yes. JC, that same, a Green Street analysis that I did, if I have my slides pulled up, I could show you, but a Green Street analysis I did a couple weeks ago showed that single-family homes should actually do much better than apartments. In fact, single-family homes are expected to rise in rental and net operating income by 8% from 2019 to 2022, where apartments are expected to drop about 8%, showing actually 7%, showing a 15% gap between net operating income on apartments, which are actually predicted to drop. They haven't yet. And then on single family homes. There's a lot of reason for that. Social distancing that you mentioned is one of them. Other reasons include the fact that some people are going to lose their homes, or they and they want to stay in that same school district. And there's a very small number of rental homes in any given school district compared to apartments. So Sean Quinlan, hey Sean, says, I was wondering, how do you see the Midwest real estate market shaking out compared to other regions? I think the Midwest in general, is more stable and probably is not going to have the huge highs and the significant lows that places like Las Vegas, Orlando, other places will have. So, Sean, I would think that it's going to be just, I would guess they're going to have some flattening and maybe some drop. But at any rate, I think that overall it will not have the huge swings. Huge swing states like Florida are where you can lose a lot of money on the way down and you can make a lot of money on the way up. And so that's why I recommend investing there. Like I've said on here before, I fully intend on getting a lease option on a Sanibel Island or Fort Myers condo if I can during this downturn, and maybe even find a bank-owned property. So Sam S. is asking, Nate Shields, Dude Real Estate, how do I identify markets with good potential? I'll take a stab at that in the meantime. There is Neighborhood Scout. If you're a Bigger Pockets Premium or Pro member, you can actually get a discount on neighborhoodscout.com. You can identify, good school districts, crime, violent crime, neighborhood income, propensity to rent versus own. That's where you look for submarkets. Now, as far as markets in general, you're going to want to use the Texas A&M Real Estate Center website. They have a lot of statistics for properties all over the U.S., and I'd highly recommend that you use the Texas A&M Real Estate Center and also the Bureau of Labor Statistics. You're also going to use census.gov. Oh, I forgot to fill out the census. Did you guys fill out the census? Anyway, I'm going to do that. I promise. So those are some things you can do. You're going to especially, Sam, want to focus on net population migration. We looked at a deal in Pittsburgh the other day and noticed that the net population migration had been negative since the 80s. In other words, the population's dropping every year. And I thought it was actually getting better. Now, that's the Pittsburgh whole region. That's the MSA around Pittsburgh. There's other cities like Austin, Texas, who are exploding. Birmingham, Alabama is growing. Florida cities are growing a lot. So you're going to want to find a place that's stacking the deck in your favor by having positive net population migration. Okay, so Todd Merritt says, is there a program you'd recommend to determine cap rate after expenses? I'm building a spreadsheet, but haven't been able to find any examples. Todd, what asset class are you in? And I'll circle back. Maybe Nikki can help me circle back, and then I'll tell you I'll tell you my answer. If you're trying to determine cap rate, actually, that's just a number. That is what it is. Okay. Now, I mean, you can calculate it, but I mean, typically a cap rate on a specific property is determined by the market in that area at that time. So, but the cap rate's also the rate of return. So it's basically you get the net operating income, which is the gross operating revenue minus all the operating expenses, not including depreciation, not including loan expenses, loan payments. And that's your NOI, your net operating income. You divide that by the price or the value of the property, and that is your cap rate. I hope that helps. Okay. Ale says, what do you think of buying standard properties versus mostly brick and mortar single family? I don't know what standard means. I'm looking to get into properties that are more resistant time and tenant use and abuse, in your opinion. Okay. So that's why I love buying mobile home parks, because the tenants bring their own home and they lease the land from you. Love it. I also love self-storage. The cleanup, when you clean up an apartment or a single family home that's been potentially abused by a tenant, you've got a lot of work to do. You know this, right? But when you have a tenant leave a self-storage property, you're typically talking a 5-minute broom cleaning and you're ready for the next tenant. The damage is very, very low. I mean, think about it. The tenants are stuff. And I know there's people attached to that stuff, but they're not usually going in and trashing a self-storage unit. So hopefully that helps, ALL. I don't know if it does. Todd Merritt says, what's the main thing you look for structurally when evaluating a property? I'm just going to generalize and say, make sure you get a great inspector who handles all that for you. That's sort of a general question, so I'm not sure I know how to give it a great answer. I was part of an inspection this week where I didn't see anything wrong, but an inspector caught all kinds of things about the supporting on some decks on the property. So they were able to see things I had not seen. Andre Smith. Hey, Andre, what do you think about using the deferred sales trust to defer capital gains on the property sale, and have you done it? I haven't done it personally, but I talked to my friend Brett Swartz this week. Brett Swartz is on Bigger Pockets, I believe, and he does deferred sales trust. He went through it with me a number of times, and actually it looks really good. He actually did a video with me. I think I've got it posted somewhere on my Wellings website that explains how the deferred sales trust works. It looks really good. There are some fees with it, but of course there are, right? And so check it out really thoroughly, Andre, and make sure that you're capturing all the upside to that. In other words, make sure that the trustee is not getting some or a lot of your upside after you make your net operating income, your cash flow from that. That's just something someone told me to look out for deferred sales trust. All right. So Wade, hey, Wade, how are you? Very much agree on the Midwest, as I'm from Iowa. We have a lot of friends and investors in Iowa. Most people are not accurate as to what the Midwest really is, but 2008 and following showed little impact at all. I suspect you are correct. Thank you. And it will be well insulated at this time around as well. Thanks for all your expertise each week. Thanks, Wade. That's very nice of you. I really appreciate that. Ramsey says, do you think Texas is a good place to invest? In what areas or cities? Texas, Ramsey's had 10 of the top performing, predicted top performing counties in the coming economic decline. And so that can also mean you're not going to be able to find a great deal. Remember Florida, that does these roller coasters, or Reno and Las Vegas. If you don't have that roller coaster, you don't have as much opportunity to get the big gains. But Texas has tremendous positive net population migration, and they continue to. And the market seems to be really hot there and continues to be so. Oren K says, any recommendation on investing in multifamily books? So Oren, thanks for joining. Brandon Turner's working on one, so we're looking for that. I'd also recommend Steve Burgess book, The Complete Guide to Buying and Selling Apartment Buildings. There you go. Dude Real Estate said that one. I've got a book called The Perfect Investment, which is kind of a primer on buying large multifamily. There's all kinds of books on multifamily out there. I'm trying to think of a few more, but Steve Burgess that one is a great one. So I definitely recommend The Complete Guide. Brandon Turner likes that book as well. Sam says, is this being recorded and can we replay it later? Yes. I don't know how to find it, but you will be able to find it later. Erez says, what's your prospect on Florida, specifically Tampa, Jacksonville, Orlando? Well, Erez, I know that last time around and in other recessions before, Florida has taken going way back to the early 1900s, at least, Florida has taken huge dives in bad economies. So be ready. There's so many good things about investing in Florida at the right time and so many bad things about investing at the wrong time. I told last week how a friend had me down to his Fort Myers home. It was a new home. It wasn't huge, but it was, a 3 or 4 bedroom home with 2 baths, granite countertops, had a pool inside, sort of. It had one of those big black 2-story screen things on the back with a pool in it. $55,000. He got it from a bank or foreclosure sale in 2009 for $55,000. That thing's got to be worth $300,000 to $400,000 or more in a good economy. Great place to buy. Ruth says, where in Texas do you recommend? Ruth, honestly, it's a great state to invest in. I would look for just mom and pop operators to buy from. We were part of investing in a $2.3 million self-storage property in Beeville, Texas, small little town with a huge self-storage property that is full, almost full. We got it from a distressed seller. It was on the market for $5 million or more. Got it for $2.3 million. A year later, this month, was appraised for around $4.6 million. So you can even get distressed deals if you know how to look for them in Texas. So small towns, large towns, it's all a great place to invest. Ken Davis says, do you think the sand states and states with lower cost of living will have population growth due to employees having the opportunity to work remote permanently? Ken Davis, that's a great thought. I don't think I'd thought of that before. I have said on this show 2 weeks ago that I think people are going to be relocating. I think that's why the Smith Mountain Lake properties just took off the last few weeks. I think there's some pent-up demand. There's some people who have had time to think about where they really want to live. They've had time to get with their family and really talk about, hey, if we could dream and live anywhere, where would it be? I've got a friend who just bought, Joe, just bought at Smith Mountain Lake in Virginia, and he basically said, hey, I just realized I can do a lot of work remotely. And so I think places with good internet and remote locations, like my son, he sells mountain land. He's had a lot of sales during this whole COVID mess. He bought, he sells mountain land in Virginia, 10, 50, 100 acres at a time. Caroline Phillips Davis says, what do you think about Huntsville, Alabama? I like that market a lot because it's got all that, all the government contractors in that area, all the military stuff. I really think that's a great market. I don't think they're going to see a huge downturn in the upcoming time period, but I could be wrong. Maybe it will be. I'm going to actually be in that area tomorrow. Jessica Henderson said, do you think waiting for the third quarter will be better to purchase multifamily? Honestly, Jessica, great question. I think third quarter will be better than this quarter, but that's only about 2 or 3 months from now. I think it would be much better if you can wait about a year. Ken McElroy says, forget 2020, write it off. He's one of the smartest investors in the world, by the way, in multifamily, if not the smartest. He says, forget 2020, set your sights on 2021 and beyond. So I think that's probably right. Okay, what do we have here? Stephen Holiday says, Midwest Rustbelt is maybe making a comeback, remote work. Also, people are going to shift from overseas, especially China and the pipeline. Stephen, that's a great point, and it makes total sense. I think the Rust Belt is likely going to be seeing a comeback. There's going to be a lot of moves to start more manufacturing in the U.S., to pull manufacturing dependency back from places like China. So, Stephen, I think you're going to see a comeback in the Rust Belt. I'm agreeing with you. I wonder what the Hillbilly Elegy guy would have to say about that as well. I'm forgetting his name right now, even though we grew up in the same town. All right. So, hey, if you have questions, we're getting ready to wind down and enjoy our holiday weekend. So if you have a question you asked earlier that was completely ignored by your rude host, please copy and paste it in right away, because we're getting ready to land this plane. If you've got questions you haven't answered, you're feeling shy, or something else I said spawned a question, please ask it now. So Sam says, what do you think about Pittsburgh and Reading, Pennsylvania? So Pittsburgh was really growing, and they were predicted to be the next Houston of the Marcellus Shale and the other oil boom that's going on in eastern Ohio and western Pennsylvania and northern West Virginia. But oil's not doing well, if you didn't notice. And I think Pittsburgh's going to be kind of, I don't know. I think maybe it might kind of screech to a halt here. It was looking like it was about to explode. I already mentioned earlier that specifically that the Pittsburgh market has a net population decline almost I think it's every year. That's not good. If you can't, if you're renting, if you got a great deal on an apartment in a great location in a town that's declining, I mean, that decline every year is just going to hurt. It might only be a couple thousand people a year out of an area of 3 million, like that area, but that's going to take a toll over time, and it's going to cause supply and demand inequity against you. So I'd be really, really careful. Ale says, I'm planning to work for some years in Cali, making around $300,000 a year, and reinvest in cheaper properties in Florida. How could I avoid to be hitting with California big taxes? Yeah, so one way would be through an installment sale coupled with a life insurance. No, not life insurance. With a loan that gives you cash up front. Okay, an installment sale coupled with a loan. If you don't know what that is and you've got a potential huge capital gain you're staring at, check in with me and I'll introduce you to my friend Bruce Jones, who will be able to help you set those up. And I think that's the best thing I can say. If you can you might want to get a really good tax planner, maybe check in with Amanda Hahn and Matt, the authors of the recent book From Bigger Pockets. Get a phenomenal tax strategist and make sure you're doing everything you can. Maybe you can even take some stuff offshore. I don't know. Todd Merritt says, your opinion on California real estate market, will it decline or go up over the next 20 years? They say there are 4 or 5 times as many U-Hauls going to Texas, from California to Texas, as there are going back. So people even get paid to drive the empty U-Hauls back to California. That should tell you something. If that keeps going, Todd, I mean, let's face it, a lot of people want to get out of California. A lot of people want to go to Colorado. A lot of people want to go to Florida and Texas. So I honestly think that it's going to be declining. I don't know for sure. Arez has something to say about this. He says the last several years in Florida has been a number 2 one-way U-Haul termination point. Okay, good. I'm wondering if we should anticipate acceleration in that migration from more expensive northeastern states. The tax law that was passed in late 2017 basically said that it actually made it more expensive to live in the really high dollar northeastern states. I think that Florida might get some benefit from that. I think it makes total sense. Hitchem Amus says, do you think market will shift from big cities like New York and San Francisco due to more rural areas and make prices hold in these metro areas? In other words, prices not go up. In other words, they'll soften. Yeah, I think that's possible. I have no proof of that, but I think COVID has caused people to say, hey, look, where do I really want to live? Even my wife and I have asked, are we really living where we want to live long term? And we are. But, it's hard to say. if it will really have a meaningful impact. Loing Wing says, buying distressed hotel and turn to studio, where to start? All right. Well, that's a great thing to do. Faith instead of fear. That's awesome. So Loing, I don't know exactly where to start on that. And when you say turning into studio, do you mean studio? Like, do you mean condos, studio apartments? I guess you meant apartments. I would surround yourself with experts. I would get a study, spend $5,000 or $6,000 to get a market study. Whether you're going to condos, senior living, which some people are doing with low-rise hotels, whether you're going to whatever you're going to do, spend the money, get experts around you, get a market study, make sure you're doing everything really, really carefully, especially because of the uncertainty of the market. I assume this is the first time you've done this. There's just a lot of things to be concerned about, and I'm all for you doing it. But just make sure you have a tremendous margin of safety if things don't go according to plan, as I said in the first 20 minutes of this show. All right, if you have one last question, this is the time to ask, and then we're going to land this plane. You know, like I said before, Bigger Pockets is the greatest place on earth to connect with other real estate investors, to learn about tax planning, to learn about how to buy and sell properties. We've got a great library of books. Bookstores is full of books, including Amanda Hahn's book on taxes and Matt McFarland's. We're going to flash that up one more time. And we want to make sure you're taking advantage of everything you can. We have forums. We have thousands and thousands of articles. We have shows like this, just so many resources. And so you're in the right place if you want to prepare yourself, your team, and your tribe. And so Sam S. says, yes, all of today's Bigger Pockets books are available at biggerpockets.com/store. So Sam S. says, which parts of Florida do you suggest looking into for multifamily investing? Florida, you know, again, just buy at the bottom, Sam. Florida just, it has 10 counties that they say are not going to be as strong. And some of those they're almost all rural counties except Broward. But again, I see that weakness not as a disadvantage, but I see it as a place for you to buy at the bottom and be able to ride up to the top. Last time, I believe Florida's property values dropped 55%, even in less beachy areas like, I mean, Jacksonville. I get that they have beaches, but they're not, you know, as famous as Miami or Tampa for their beaches, yet they still dropped 55% in the last recession. It's very likely you'll have opportunities like that as well. Jaharia says, can a foreigner buy real estate in the U.S.? Absolutely. You can definitely invest with others who have syndications in the U.S., and you can buy in the U.S. as well. Put that question on a Bigger Pockets forum and you'll get lots of great answers. Again, Bigger Pockets is a place to get answers like that. ALL says, as baby boomers are retiring, what's your opinion on buying new, a well-planned building made to last and be efficient to be an ALF, or buying used? Well, so assisted living facilities are not doing quite as well during this COVID virus. And I hope that's just a short-term blip. But I really think buying a used building or a new one in the perfect market with a market study for ALF or just for senior housing in general. I'm not talking about skilled nursing facilities. That's a whole nother level of complexity. I think it's a really good location. Now, 10,000 people in the U.S. turn 65 every single day. And 6 out of 10 have less than $10,000 saved for retirement. So a lot of those 6 out of 10 might end up in low income housing or mobile home parks. It's one of the reasons I love mobile home parks. But the other 4 out of 10, maybe 1 or 2 of those will end up in assisted living or senior housing someday. Only one or two have to have the money to afford those for you to be able to have a profitable investment. And we are looking, my company, Wellings Capital, is looking at the opportunity to invest in senior living ourselves. Christopher Sprin says, would you take money out of 401k to start investing? Christopher, you can check the rules on that with the new, the 401k, the new laws being passed because of COVID. If I had the opportunity to take money out and I could use it for a while before I had to pay it back, maybe, I would be prepared to take it out. And that's one of the points I made in the first 20 minutes of the show today. I didn't mention 401k, but have sources of cash you can get to immediately if you need them. Christopher, I would certainly recommend that you be ready to take it out, be looking for deals, looking for the downturn, and be ready to take it out. Okay, Ruth says, do you think Houston's a good place to invest? So I used to say, the west side, the I-10 corridor going west of Houston was a little risky because of oil and gas, but the east side, the way over on the east side where the ports and the production facilities and the logistics is not as risky because they don't go up and down as much on oil. But this latest crisis is likely the worst crisis in the history of the oil and gas industry, just since February 21st, I believe, to now. I think it's shown that Houston, if Houston does well now, I really will believe what their mayor and their others have said, and that is that they have a diversified economy. They claim to only have 11% dependence on oil and gas in Houston. Well, if that's true, it's going to be stress tested right now. They also have obviously they have a huge center, the Texas Medical Center in southeast Houston. That area is going to be, medical has been down a little bit during COVID. If Houston's ever going to be tested, now's the time. So we'll see if it does well. I have my doubts about Houston, but who knows? Maybe it will do as well as they predict. Okay, so I love you all. Thank you so much for joining me. I'm amazed that I get to do this. I'm Paul Moore from Bigger Pockets and Wellings Capital, and I am amazed that I get to be here with you. Thank you so much. Thank you to Nate Shields today for answering a lot of questions. Thanks to Bill Coppage for helping out and putting in some good input before the show. Kevin Roop, one of my heroes. Thank you so much, Kevin. Thank you so much, Nikki Frick, who is joining us on what should have been a day off. She is joining us to produce this amazing show and put in the subtitles and all the amazing things she does. My hat's off to all you. Thank you for all you do. And we look forward to seeing you next week here at Bigger Pockets.